Today is August 31st. Welcome in. With the last up move in the market, we were able to close the diagonal we had on for last month. We took a small profit there. We were able to avoid any losses this month, even though the market had a pretty significant down move. That puts our core strategy at 14 out of 14 trades this year, and that puts us up over 35% return so far. Now I have two open bear traps set further out in time than normal, testing using a little bit less buying power, maybe diversifying the time periods. Instead of one trade per month or two trades per month, we could do 3, 4, 5, 6. Let's jump into the platform and we'll take a look at the risk graph. We trade MES because it's one of the most liquid products, and we trade the futures because we can get the most leverage. So you can see these dots indicate open positions. Now we have one spread at the 22 delta and the 28 delta. We sold the 4,300 put. We bought the 4,400 put. It's a $100 wide put spread. That's going to hedge against our short put that's at 3,800, 7 delta. There's a 93% chance of that expiring out of the money in 141 days. So that's the first one. This one is 43.50 and 44.50, and I was able to sell all the way down at 35.50. That's a 5 delta, so that's a 95% chance of that expiring out of the money. So the stock market would have to drop 1,000 points for these to really be losers in 6 months. So these are bullish strategies, but if the market were to drop 400 or 500 points, even 600 or 700 points, these would still be profitable and very profitable. So let's jump into the curve tab. Alright, now we're in the curve trade mode and we can analyze the graph. Both of these trades were put on in the last few days. So you can see here we're up $30 already on with these trades. If the market were to go up, they would be more profitable. The credit is $43, so that's the max we can make to the upside. Now, if the market drops, obviously if the market drops tomorrow down to the short strike, we'd be down $600, but the probability of that is next to nothing. So now what's going to happen over the life of the trade is that this trap is going to start to form and move down lower and lower on the graph. So after a couple of weeks, if the market stays here, we'll be up $120. The expected move is normally a little bit inside this first standard deviation, which is this blue dotted line. So this hump is forming right at the expected move to the downside, and then it starts to flatten out near the expected move to the upside. So you have this long tail if the market goes up more than expected, and the only way you lose is if there's a crash. It would have to bring you down to the 2 standard deviation line, which is a less than 5% of the time. So we could lose $800 if the market went all the way down in between our short strikes. We could make $250 if the market drops but stays in its expected range. We can make $120 if the market stays here. We can make $40 if the market moves up above the expected move. The great thing about this trade is it's only using a couple $100 in buying power. If the market crashed and volatility expanded, we can actually see where this would be. If the market fell towards the 1 standard deviation, we would be up around $250. Now let's see if volatility increased over all these strikes, how would that affect this trade? So we can go in here. Obviously, increasing the volatility on our short puts, this 3,800 and this 3,550, that's going to hurt everything. If that happens, it takes away all of our profits. Now, if that happens with the put spread, that's going to bring some of our profits back. But this is going to be a little bit more like what it could look like if volatility increased a lot. And this would not be good at all. At that point, we wouldn't be making any money at the expected move to the downside. It would push our trap all the way up to about where the put spreads are. And there's almost there's like nothing behind it to help. We'd make $68 if the market stayed where it is, and that's it. It would just go down from there in each direction. From $250 to $70, and from $4,200 to $4,600. That's 400 points higher. Interesting. So what can we do to hedge against that? That's scary. That's really scary. Worst case, market crash down here, that's $1,200. How could you make that up? You're not going to make up $1,200 making $70. But you could making $250. 5% across everything is not crazy. That's what happens when the market falls. See, but then at that point, what if I just hold it? If I hold it a little bit longer, look what happens. Even with volatility expanding, holding it a little bit longer pops the bubble right back up where it was. Look at that. And then you actually make more money. Then you can make $300 here. And your break-even's all the way down at 3,900. Let's just keep going. Hold it a little bit longer. Look at that. Then you make $700, $750 to the downside. Look, your break-even goes below 3,800. And if it's close to that, you can make $750. But there's more. Look at this. Still $125 if it just stays here. Yeah, great. $50 if it goes up. Look at this hedge that you have in the back. Hundreds of dollars wide here. This trap is big enough for a bear. Jesus, look at that. That's 600 points wide. If you go from this 3680 to 4480, that's 700 points wide. We have a 700 point wide trap that we can make $1,000 in. And that's with the volatility expansion. If I go back and reset it, it honestly didn't even really do much. It pumped it up over 1,000. Alright, and that's when the one expires and the other one's still going. See how it kind of curves it but gives it some pointy edges? It's beautiful, man. Now, like I said, if the market goes up, you're never going to be using any more buying power. So if you put this trade on and the market goes up, you make $45, but you only put up a couple $100. So your return technically on the trade is pretty good, like very good. Now, if you only have $200, should you be selling a put far out in time, far out in strike in a futures product? Definitely not. You're only selling a put really far out in time for $200 if you have 20 times that amount. Anything can happen. The buying power will expand a lot more than you expect it to if the market starts crashing. So if you want to be able to hold this trade until the end, which you need to do to really make any money off of it if the market were to fall, you have to have buying power left over. You cannot be using your whole account when you're trading futures. Alright, it's been good so far. We're having a great year. This strategy's been working amazing. I really like how the risk graph looks further out in time. Not using as much buying power, so we can make these trades even smaller. And then we can do more of them. So that's never a bad thing. So I hope you like this video. Don't forget to hit the like button and subscribe. Peace.